trading desk of dailyforex.com. This is Christopher Lewis looking at the upcoming July 17th Forex session in the euro dollar. Interesting day coming up as the Federal Reserve Chairman Ben Bernanke gives testimony in front of Congress, and the world will be waiting and listening to see if quantitative easing is coming. Any hints of QE3 would, of course, be very dollar negative, and as such could give a pop to this pair. However, looking at the charts, as you can see, we did form a little bit of a bottom, and we bounced from an initial fall during the Monday session. This suggests to me that perhaps we're going to try to build a little bit of a base. After a precipitous fall, though, realistically, this is almost a given. Sooner or later, the pair had to bounce. Because of this, even though a break at the top of the hammer candle would be a bullish sign, I think that truthfully the 124 level will be the beginning of a barrier that this pair is going to have a lot of trouble breaking through. Unless Bernanke specifically says that they're going to ease some ridiculous amount of bond buybacks or something to that effect, it's really hard to believe that this pair will chew through that. My suspicion is that any pop to the upside will simply give us an opportunity to sell this pair at higher levels. As you can see, obviously the trend's down, so it's much easier to just go with the trend, let it do its thing, sell it from a higher level. You can see though, and if you've been watching the videos, you know that I had been watching this bearish flag that broke away, and it does suggest 115. I still believe in that. That's really not that big of a stretch, considering that just in April, we were up here at about 133, and here we are at 122. So, and at one point in time, we're actually at 121.50. So, having said that, a fall of another 1,000 pips from basically here isn't really that big of a deal. So, having said that and looking at the analysis, my opinion of this is that this is a rally that could come, and it would make sense, but it's to be faded. Taking all of this into account, and also you can draw the fibs from the fall and use those as a reference as well. Ironically enough, the bottom of this area is right about at the 50% Fibonacci retrace from the fall, so that of course could get several things going at once. As a result, I will look at any rally in this pair, which more than likely could be a knee-jerk reaction to something that Bernanke says, as an opportunity to sell. After all, you have to think that even if the US is going to ease again, it changes nothing in Europe. We still have concerns about the euro even existing in a few years. There aren't those concerns about the dollar. We hear a lot of conversation about the debt and the deficit, and all of that is certainly true, and it makes sense. But the world isn't focusing on that. Would you rather put your money in a country that runs massive debts and you know that it could be devalued a bit, or would you rather put your money in a country, or a currency in this case, that may not exist in 3 years? Those are really the choices that a lot of investors are thinking about. And if that's the case, a little bit of risk of currency devaluation certainly is no big deal when it compares to the possibility of a complete devaluation.